Hey guys, this is Rudy coming at you live from Palm Beach. I'm assuming that you might have watched part one of this sort of, let's call it 3 or 4 part series. This is part two. What I'm going to do here is talk about five more energy stocks. They are really super majors from all over the world that I'm kind of whittling through and trying to find the maybe top two that we can add to our energy portfolios. And I welcome your feedback and your objective opinion in terms of whether some of these are buys or not. So in the first video that I made, so as I said, this is part two. If you didn't watch part one, you can always go back and find that one in the library. But in this particular video, what I want to do here is discuss the next five. So we have five super majors here, right? So I have Phillips 66, Equinor, TotalEnergies, Exxon, and Suncor. And as you can see, they are international companies. So I'm not limiting myself geographically to US super majors specifically. I'm shopping all over the world for the best energy buys that I can find. I am hesitant to say that there's a buy that jumps at me. Like a few years ago, it was so easy for me to say buy Occidental Petroleum because it was unbelievably cheap at $10. I don't have another one of those. If I do find one, I'll share it with you. But until I do, you're just going to have to bide your time and work with me and maybe educate me as you go along. Because if you find one before I do, please share, right? But these are the five we're going to talk about now. So let's jump in here. So I can buy all of them on the New York Stock Exchange. So from that point of view, for me as a US person, excuse me, they are easy to purchase because it's on my local stock exchange. You can look at the industries down below and you can see that they are mostly the same, but not exactly identical, right? So I have oil refining and marketing that comes up 3 times. I have integrated oil, Canadian, and then I have international integrated, which is Exxon. The other thing that's an outlier here, much like in the previous video where 4 of them were ADRs, in this particular instance, I have 2 ADRs. An ADR is an American Depository Receipt. So I'm not buying the shares, I'm actually buying a note that is sort of equal to the value of one share. And the other three, so Phillips 66, Suncor, even though it's Canadian, and and ExxonMobil, I can buy on the New York Stock Exchange and own the shares outright. So 3 of them are direct shareholdings for me, single stocks, and the other 2 are ADRs, which is kind of equivalent to a single stock. The only difference there is that on an ADR, I incur a small fee. So if I hold the ADR instead of the stock directly, I need to also take into consideration that I have a small fee that I need to pay, right? So otherwise, they are sort of the same or at least similar. From a pricing point of view, a couple of them are outliers, trading at over $100 per share. The other 3 are sort of in the, let's call it $30 to $50 range. So they're more or less priced the same. Now, the price itself, of course, doesn't really mean anything. You need to dive at least 1 or 2 levels deeper to find out if the price is actually a fair reflection of value. And now, a good time to get in or not by looking at another couple of benchmarks. One of those is the 20-day raw stochastic. So when it is above 80%, and I know I'm being superficial here in terms of how I interpret this for you, but I want to make it simple. If it's above 80%, the stock is hopelessly overbought. So based on this 20-day raw stochastic on its own as a benchmark, which you should never do, right? Right? You can't just look at one thing. You need to dive a little deeper. Equinor is not a buy. It is hopelessly overbought at the current price, and probably one that you should eliminate. But you can keep it on your watch list, right? It's a great stock for a variety of other reasons. I'll come back to that in a minute. The others, are sort of more or less 20, 30, which is fine. If it's below 20, it's hopelessly oversold. So you can see Exxon as a single stock, one of the largest energy companies on the planet, is hopelessly oversold based on the 20-day raw stochastic. If it's below 20, so Phillips 66 is close, Exxon is below 20 already, it's oversold. If it's above 80, it's overbought. So based on the 20-day raw stochastic alone as a benchmark, Equinor is not a buy, and Phillips 66 and ExxonMobil certainly is. From a PE point of view, price earnings, TTM means trailing 12 months. They're all reasonably priced. The most expensive two are the two I just said are the most likely buys, right? Because they're hopelessly oversold. So Phillips 12 and Exxon 12.3 are the higher of the price earnings ratios if you use that as a benchmark, and you should. Now, the fact that they have a PE ratio of around 12 is still attractively priced because the market average is around 15 right now. The others are relatively super cheap. 7, 8, and 7, respectively, means that they are very, very well priced right now, the stock price, based on its price earnings ratio. Let's go a little bit deeper and we look at the annual sales of the company. So on the far left side here, I have Equinor that is generating $107 billion in sales, and it has a market cap of only 66 billion, which means its sales exceeds its market cap by 162%, right? So if I do the same math for the other five, Phillips 66 is at 312%. How's that for an outlier? Suncor and Exxon are actually kind of normal. Normal would be sort of 50, 60, 70%. So they are sort of, relatively speaking, normal, right? And Total at 170 is also quite a dislocation between sales, $219 billion compared to a market cap of only $128.5 billion. So looking at this as an example, Phillips 66 is going gangbusters here, right? We have annual sales of over $147 billion a year with a market cap of only 47. This to me looks like a screaming buy. Well, if you look at it from a dividend point of view, you'll see that the dividends, the ex-dividend date is all in the past. You need to own the stock before the ex-dividend date, the day before the ex-dividend date, in order to earn the dividend. But these are all behind us. So we're looking forward for Q1 of 2025. If you buy it sort of now-ish, then you'll be eligible for the dividends that they pay out because you would be owning it long before the ex-dividend date. If we look at it in picture form over a 3-year period, that's a reasonable period to hold a stock long. I like to always look at it from the point of view of saying I'm going to go long, and I'll go long for 3 to 5 years, like I did in the past with some of the stocks I've shared with you many times before, including Occidental Petroleum. The absolute outliers here in terms of performance has been Exxon. Over 3 years is up 62%. And we have Phillips 66, 36%. The others haven't done too badly. In fact, Suncor and TotalEnergies. Suncor is Canadian, Total is French. Call it 20% or thereabouts. So not too bad. Equinor has been the poor performer, but Total over a 3-year period, not good either. So really the two good performers here, if we look at the sort of performance, generally speaking, over a 3-year period, has been Exxon and Phillips 66. They've been the best performers by far. Let's take a look at these companies. I'm going to their website, just one page. I want to see what it is that they do according to what they say they do, not what I say they do, right? So Equinor says, we don't just energize people's lives, we want to empower them too. At the bottom here, it says, at the same time, we aim to be a net zero company. Get out of here. You're a net zero company? Your solutions are oil and gas and renewables and low carbon in the energy transition. Net zero by 2050, you're out. Sorry, I cannot invest in this company. If your aim as an energy company is to be net zero and to find new solutions to oil, gas, and renewables and low carbon in the energy transition, I can't invest. You're welcome to do so. Not me. I'm out. Thank you. Bye-bye. Let's take a look at Equinor anyway, just as a snapshot here. Sorry, am I sounding a little bit overly negative? Anyway, it's not a bad buy. You can buy Equinor for about 24 bucks. Its stochastic score, as I said, is hopelessly overbought, so you don't want to be buying Equinor right now. It's 52-week range, 21 to 32. It's trading sort of just off the low there. Price earnings ratio is attractive. And down here at the bottom, you can see it pays a huge dividend, $2.51 based on a stock price of $24 is yielding 10.59. That is pretty good. If you're buying it for its dividend, you could probably buy it and hold your nose at the same time while they try to be a net zero company by 2050. But remember, depending on the jurisdiction that they operate in, they have to say these things because otherwise they get into trouble. In a few years from now, it might all be blown away and blown over and gone away. But for now, that's what they say. And I don't particularly like that. Just from a personal point of view, it's just my opinion. You can ignore it. How about Phillips 66? I like this much more. Providing energy, improving lives. How simple is that? What is the reason for your existence? What's your mission? What's your purpose? To provide energy and improve lives. Did you know that energy, specifically oil, has lifted more people out of poverty than any other thing or resource or action in the world for the last 100 years? If it hadn't been for the fact that we discovered oil, we all collectively would have been significantly poorer. You don't believe me? Just go and visit a museum, preferably a museum where a king lived like over 100 years ago, uh, even just 100 years ago. Somebody really, really rich, right? So, how about like from a US point of view? Let's say, for instance, you go to the Rockefeller Mansion from 100 years ago. Hey, man, the guy didn't even have flushing toilets, right? But oil as a discovery has lifted more people out of poverty than anything else. Anyway, I like this. Phillips 66, providing energy, improving lives. Simple, sweet, to the point. You can buy Phillips 66 for about $114 on the New York Stock Exchange. In its 52-week range, 108 to 174. It's near the bottom, right? 108, $109. It's currently available for you to buy at $114. Low stochastic score. It's attractively priced. It's a buy. Price earnings ratio of only 12. It's reasonable. It's not the cheapest stock in the market, but it's pretty good. Nice dividend, $4.50 at the current stock price is yielding approximately 4% on an annualized basis. Pretty good. I like Phillips 66 here. So chalk that one down for me as a potential winner. How about Suncor? At Suncor, we produce and provide energy. It's kind of like Phillips 66, right? Why do you exist? What's your mission? What's your purpose? Well, we know exactly what we do. We produce and provide energy. Sweet, man. That's what I want to hear from a company that's an energy company in this day and age. Suncor, you can buy for around $36 on the New York Stock Exchange on its 52-week range. 31 to 42, so it's sort of in the middle there or thereabouts. The stochastic's only 40, nice buy. Price earnings ratio is only 9, nice buy. Nice dividend too. $1.63 is yielding 4.56 on an annual basis. Pretty good for a stock that's currently trading at $36 to pay you a dividend of that high. Total, how about this one? We produce and market energies. Yeah, we know that. Oils and biofuels, we know that too. Natural gas and green gases, renewables and electricity. Green gases, renewables, and electricity. They have to. They're French, right? In France, by the way, most of the energy is generated through nuclear. So anyway, Total is also there. Our purpose, here we go again, is to provide as many people as possible with energy that is more affordable, sweet, more reliable, sweet, and more sustainable. It's okay. At least they know what they are meant to do and what their purpose is in life, right? So it's not like I want to figure out what I want to be when I grow up. They already know and they're telling you. Total you can buy for around $55. Its stochastic shows you that it's a reasonable buy at the price, $55. In its 52-week range, it's trading at near the bottom, 53 to 75. Price earnings ratio of only 7. Sweet dividend too, $2.47, currently yielding 4.54. Nice stock, Total. Not bad at all. How about Exxon? Who we are, fueling the world safely and responsibly. At the bottom here on the side, focus on safely meeting the world's energy and product needs. I don't have to tell you too much about this one. A couple of years ago, they were heavily under attack from some environmental sustainability groups who are trying to focus on a green earth. I'm trying to focus on providing energy to the people. The millions and millions of people, hundreds of millions of people don't even have clean drinking water, right? They need energy. There are people in countries like China and India that need energy. The energy demand is off the charts. Just for context, we currently consume just over 100 million barrels of oil equivalent per day, and it's edging up every single day. Energy is a sweet place to be if you want to park some money and invest it, especially longer term. You can buy Exxon for about $107. It's not a bad price at this time. The stochastic is low. The 52-week range is $96 or thereabouts to 126. So it's sort of in the middle. And price earnings ratio is okay. It's reasonable. And it pays a nice sustainable dividend. It's been paying dividends for a long time, $3.84, which are currently yielding 3 5.57% on an annualized basis. So I have three winners here to add to my winners from the previous video. So now I'm down to five, right? I started with the top 10 or 10 energy companies, and now I'm down to sort of my top five. In this particular video, I'm going with Phillips 66, Exxon, and Suncor. I'm not going to invest in five stocks. I'm probably going to invest in two. So this is part two of a five-part series. And what I want to do is to share with you sort of my top 10 that I picked. And by the way, I picked all 10 of them because they also pay a good dividend. And it looks to be a sustainable dividend on an ongoing basis. The only one that's a little bit of an outlier there, not because the dividend is bad, the dividend is actually fantastic, is Petrobras, but a little bit more unpredictable than the rest, who typically just pay a quarterly dividend. But now we're down to sort of the top five, right? So what I'm going to do in the next part, which is part three, is just take the top five and line them up, the five of them up side by side, and then see how that plays out. And then we'll maybe do a deep dive on two of them. And I'll go along in January of 2025 on whatever my two winners end up to be. But that's where I am for now. This is part two. I hope you're enjoying this little energy travel with me, and I'll be back soon with part three, where I whittle it down to my top five. Talk to you soon. Bye bye.